Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CAL-MAINE Foods Inc. quarterly report. CAL-MAINE Foods Inc. offers a diverse range of businesses and services that cater to various customer needs. The company's primary focus is on the production, grading, packaging, marketing, and distribution of shell eggs, egg products, and prepared foods. The company provides specialty shell eggs under different brand names, including cage-free, organic, brown, free-range, pasture-raised, and nutritionally enhanced eggs. These eggs are marketed under well-known brands such as Eggland's Best, Lando, Lakes, Farmhouse Eggs, Sunups, Sunny Meadow, and 4Grain. In addition to shell eggs, CAL-MAINE Foods also offers a variety of ready-to-eat products, including hard-cooked eggs, egg wraps, protein pancakes, crepes, and wrap-ups. These products are designed for convenience and can be easily consumed on the go. The company's services extend beyond just production and distribution. It also sells feed, miscellaneous byproducts, and resale products to its customers. This comprehensive approach enables CAL-MAINE Foods to cater to the diverse needs of its customers, including national and regional grocery store chains, club stores, independent supermarkets, food service distributors, and egg product consumers. Overall, CAL-MAINE Foods' business model is centered around providing high-quality eggs and related products to a wide range of customers across different regions in the United States. CAL-MAINE Foods Inc. maintains a market capitalization of $4 billion, broadly in line with the industry peer group. CAL-MAINE Foods Inc. trades at a lower price-to-earnings ratio of 6 times and a higher price-to-book ratio of 1.38 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 17% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. At the same time, profits have grown exceptionally fast while the share count has declined. This suggests management is generating substantial earnings while actively concentrating value into fewer shares, an extremely positive signal for long-term investors. The company have a dividend yield of 6.06%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline in the industry can be attributed to several key factors. On the growth side, an increase in net sales, conventional and specialty shell egg sales, prepared foods and egg product sales, and strategic acquisitions such as Echo Lake Foods have all contributed to revenue expansion. Conversely, a decrease in USDA daily average price for large shell eggs, depopulation of hens due to HPAI, and decreased prices of shell eggs, leading to lower cash collections from customers, have been the primary drivers of revenue decline. Additionally, conventional egg sales and specialty egg sales have also seen a decline due to price and volume fluctuations. Overall, these factors highlight the importance of market trends, pricing strategies, and supply chain management in driving revenue growth or decline in the industry. The net income of the company underwent significant fluctuations over the period in question. Initially, it increased from $478 to $635,670, indicating a substantial growth. However, this trend was short-lived, as the net income decreased by 42% from $876,102 to $353,152, and further dropped by 60% from $508.5 million to $352.6 million. The decline in net income can be attributed to various factors. One major reason is the decrease in cash collections from customers due to lower prices of shell eggs. Additionally, increased expenses such as delivery costs, marketing expenses, and professional and legal fees also contributed to the decline in profitability. Profit margins also suffered significantly during this period. The gross profit margin fell from 41.8% to 27%, while the operating income margin dropped from 34.8% to 17.2%. These declines indicate a substantial erosion of the company's profit margins, making it challenging for the business to maintain its profitability. The combination of decreased cash collections and increased expenses led to a decline in net income and profit margins. The company's inability to pass on higher costs to customers due to lower egg prices further exacerbated the situation. As a result, the company's financial performance suffered significantly during this period. The company is experiencing a significant increase in its operating cash flow, indicating a strong financial position. According to the provided data, the net cash provided by operations for the 39-week period ending February 28, 2026 was $476,922. This amount represents a substantial positive operating cash flow of $476.9 million. This trend suggests that the company is efficiently managing its resources and generating sufficient revenue to cover its operational expenses. The positive operating cash flow indicates that the company has the ability to meet its financial obligations and invest in future growth initiatives. Overall, this development is a positive sign for the company's financial health and stability. The company's financial health has undergone significant changes in terms of its debt level and interest expenses. A closer look at the interest expenses reveals a notable increase from $266,476 to $385,126, representing an upward shift of $118,650. This trend is further supported by another instance where interest expenses rose by $50,000, from $457,000 to $507,000. While there is no clear indication of the debt level change, it can be inferred that the company's financial situation has become more burdensome due to increased interest expenses. The absence of any long-term debt payments information for the previous year makes direct comparison challenging. However, the fact that no amounts were borrowed under the credit facility as of February 28, 2026, suggests a cautious approach by the company in managing its debt obligations. Management is emphasizing a defensive approach in response to potential claims, acknowledging the possibility of treble damages. However, they are also looking ahead, with a key strategy focused on adapting to changing market conditions through their share repurchase program. This program will enable the company to opportunistically purchase shares from time to time, utilizing existing cash balances and future free cash flow as funding sources. The management is confident in the company's ability to meet its short-term cash needs, with sufficient funds available for at least the next 12 months. The company's financial activities have been transparent in their annual reports. One notable aspect is the payment of dividends to shareholders. The company has consistently paid dividends over the years, as evident from references on pages 21, 25, 36, 41, 42, and 43. In addition to dividend payments, the company has also engaged in share buybacks. This strategic move aims to boost shareholder value by reducing the number of outstanding shares. The company's decision to buy back shares is reflected in references on pages 35, 41, and 42. There are concerns about inventory buildup or supply chain disruption that may impact the company's ability to meet customer demand. Volatile market prices for eggs and feed grains can lead to supply chain disruptions, which have already been experienced by Echo Lake Foods in the form of temporary production volume reductions and higher costs. Global supply chain disruptions are also mentioned as a potential factor contributing to volatility. This suggests that the company may face challenges in maintaining a stable supply chain, which could further exacerbate concerns about inventory buildup or disruption. That concludes the financial summary for CAL-MAINE Foods Inc. Feel free to comment below, and I will be happy to answer them when possible.